Housing. That is my boy, Lance Lambert from Resi Club Analytics. Lance, Happy New Year. How you doing?
Doing good. Hopefully it's a great 2025 start for everyone.
Absolutely. I think 2025 is going to be the year of the investor. We are going to find and create some amazing deals. Let's talk about your roundups. You have done roundups for active inventory, for mortgage rates, and of course, the creme de la creme, home prices. Why don't we do it in that order? What are people calling for active inventory in 2025?
Yes. So every year I do roundups of different forecasts out there. This is my most robust year, and I went deeper for all of my Resi Club Pro members. And so I'm going to show you 3 of the reports that I sent out for them for inventory forecast, for mortgage rate forecast, and for home price forecast. I'm going to go ahead and share my screen. Okay, I think we're good to go. So let's start with inventory. When assessing pricing momentum in a market, my group, Resi Club, we really think it's important, and I think Zuber, you have the same view. It's important to monitor active listings and months of supply. Mm-hmm. It's really that equilibrium of supply and demand. If you have a lot of new listings rush into the market, that can swing it, like we saw, back in before and during the bust with the foreclosures. The other way, of course, which also happened back then, is if you have the weakness on the demand, suppressed demand, homes aren't selling as fast as they were before, and the actives start to build. In the market we are in today, nationally, we've seen actives move up 26% year over year. That's not because there's a lot of new listings. New listings are actually fairly low. What it is the market nationally aggregated, and this is more so in the Sun Belt and the Gulf area and the Mountain West, has seen suppressed housing demand. Homes are not selling as fast as they were before. They're taking a little longer to sell. The things that were, kind of like the lemons, the homes that maybe are a little less ideal, right? The things that are going to take more work to fix up, the things that would sell very quickly during the boom, those types of homes in particular are taking longer to sell, and not necessarily, ready to move in entry level, right? That's not necessarily where the inventory growth has been. But so actives have moved up 26% year over year. We're still down about 17% from pre-pandemic levels. So it's not like we have a huge glut of active listings on the market, but the market is definitely a market where I would say if you zoom out a few years, we're in a place where buyers have a little more power on a relative basis than they did 2 years ago, and sellers have a little less power, or maybe I should say 3 years ago. Some markets have gone from sellers markets to balanced markets. Some markets have gone from balanced markets to buyers markets like San Antonio and Austin. And then some seller markets have just gone from crazy seller markets to just seller markets, right? So the trajectory has shifted a little bit into buyers' favor as actives have moved up. And so where are the forecasts? Here we go. We have Housing Wire, which is the Altos One research. We have Bright MLS and Realtor.com. And I don't know what their methodologies are exactly, but all of them are almost in the exact same place. Housing Wire expects actives to go up 13%. Bright MLS expects them to go up 12.8%. Realtor.com expects 11.7%.
Now, if I'm reading this chart right, we're sitting today roughly at 980,000. Is that right?
In the Realtor.com series. So this is condos and single family co-ops, townhomes from Realtor.com. Subtract, you take off all the pendings at the end of the month. Right. And you'll see some different numbers here. NARs is always higher, but they have a different methodology. And then Altos is always lower. They have a different methodology, and it's just a single family that they publish.
Okay. So the reason I asked that is I'm trying to figure out since they're all calling 13%, if we're sitting at 980, that means we're going to see, roughly speaking, what is that, 130,000, which is about again, rough math, 11,000 new listings a month. It obviously won't break down that way, but that's what I'm seeing. So we're gonna see inventory build about 11,000 a month, roughly.
Yeah, that's kind of their
Okay.
ballpark. So of these forecasts, the average is 12.5%. And if you do the math here, that would take us just under 1.1 million homes by November 2025.
Okay.
That would still
Got
be
it.
6% below pre-pandemic levels of around 1.15 million.
So it's funny when you think about active inventory, because there are two factors that could impact inventory growth. One obviously is new listings, and the second is less demand, right? Because either one of those or both can lead to active listings growing. It'd be curious to see which, like, are we seeing more sellers fly off the sidelines in list, or is it just people with demand, 7% rates suck and nobody's playing ball? That's,
So
I'm curious.
my view here is, so my view is there's a few different things that go into it. And then some of these kind of crisscross across those buckets that you created for those two. And the one that crisscrosses is the new home supply. So right now, the markets that have more home building going on, which these are the markets that always have more home building going on, right? Texas, the Floridas, right? A lot of these Sunbelt markets, Arizona, those markets have seen actives move up more and resale actives. And I don't think it's necessarily because the new homes are hitting and that's what's accumulating in the actives. My personal view is that I think because those builders have to continue to move inventory, and Lennar's CEO came out the other day and said, when needed, they'll do affordability adjustments, the rate buy downs bigger to, continue to maintain sales pace, right?
Yep. Pace over profit. Yep.
Yes. And so, and they have the gross margin, they still have the profit margins to do that, right? It's not like they're selling at a loss, right? They're still making money.
True. Yep.
Just not as good as they were during the boom. Now, as they do that, that attracts the attention of some buyers who would have otherwise looked at the resale and existing market, and then they go to the new, right? Because the existing and resale side, unless they have to, they're not coming down on price. Unless they're forced to, or they have their other home that they're ready to buy, and so there's like that, or circumstances really force their hand, right? They're going to fight it more. Builders, they're going to want to continue to maintain sales volume. And so we've seen some of that. And I think that supply coming in has weakened the demand for the existing and resale market and pushed up the inventory. And then the second factor at play, and there's three factors I would say. The second factor is just there's suppressed demand and supply in the market, right? From rates moving so high, but that suppressed demand is demand's not like it was a couple years ago, right? When rates were very low, right? So homes take a little longer to sell, and they were at a place where like homes were selling the fastest ever during the boom, right? So coming off of that allows inventory to build up more, right? And then the third factor there is we're in that suppressed demand environment, and the lock-in effect it's still at play. It's very much still at play, but it's eased up a tick. It eased up just a tick in 2024. And that tick it eased up did not get absorbed by the buyers in demand in the market. And so actives increased. So I think next year, the most likely for actives to grow is not that demand goes down more. I don't think that will be the case. I think demand, my personal view is I think unless there's recession, I think housing demand is troughed. But I think what could happen is that housing demand might not increase that much. And if the lock-in effect eases some, and that doesn't get absorbed, just like we saw in 2014, that allows the actives to more normalize closer back to where we were pre-pandemic levels.
I like it. Okay. Makes total sense.
And I think there still is the very much a regional bifurcation at play here, where the Sunbelt markets and the Gulf is the most weakness, and still the tightest in the Northeast and Midwest.
All right, very, very cool. Well, that's active inventory. Let's take on mortgage rates next.
Yes. So mortgage rates, I have 14 different ones here. I do have a couple more that have since rolled in and a couple revisions from this. But when I published this, which was the beginning of December, the average of the 14 was 6.3 for next year by the end. So this
is December 31st, 25.
Exactly.
Okay,
This is where these forecasters expect mortgage rates to be at the end of next year.
Got it.
And the range here is from 6.8 on the high to 5.8 at the low.
Okay.
And you can see here I've dotted them all. It's not exactly, even if the most optimistic NAR is right. Now that does start to be a big divergence from where we are today. But if you take it to like the second or third most optimistic, and it's closer to like 6.2, that's not necessarily too dramatic from where we are today. It was back to where we were in September, which when we were at that environment, we did start to see some tickle of activity, right?
Oh no, that 6.1, 6.2 demand came off the sidelines.
Yeah.
It's pretty clear.
So the three most optimistic ones, especially NAR though, is where you're starting to get a different environment from where we are today. Maybe not super dramatic. Maybe the NAR one is.
Oh yeah, 5.8. Yes. Yeah.
Now the 6.8s and most of these 6.5, 6.6, by the end of the year, not necessarily that big. And plus, even if some of these are right, you don't exactly know where the rates would be. Even if it ends there next year,
right.
It doesn't necessarily mean you're there in the peak activity season in the spring.
Correct.
Which we both know that's, that one's really key. Like if we get a 5.8 in spring versus a 5.8 briefly in a December,
very different. Very different.
And so those are the rate forecasts. Nothing too interesting there. I do want to read a quote from Hunter Housing Economics, Brad Hunter. He said, mortgage rates will not fall the way many analysts have been predicting because the pressure that the federal debt in the U.S. will have long-term on mortgage rates.
Yep.
That has been a part of the story that's been at play, right? Even with the disinflation and deceleration inflation, as financial markets kind of assess the outlook for the fiscal environment and how many treasuries are actually going to be produced, that's put, according to some analysts like Brad Hunter, upward pressure on mortgage rates.
Yeah, I think mortgage rates have a lot of risk in the first half of the year. We have a lot of potentially inflationary things coming, which could take up expectations. Calling the end of the year is more of smoke and mirrors, but yeah, I see a lot of rate risk in the first 6 months for sure.
I do want to say though, with these rate forecasts, it's very important for me to point out that economic forecasting for financial markets has never been easy. We've been through a very challenging and unprecedented period with COVID-19 lockdowns, the extraordinary level of fiscal and monetary intervention, and then that was all followed by a 40-year fastest rate hiking cycle in 40 years, right? And so it's, there's some complexity. And Resi Club, we approach all these rate forecasts with a healthy dose of skepticism. And I think one thing that's important, and I think we're both on the same page on this one, is if the labor market were to unexpectedly weaken, rates could drop more than anticipated. And if it's the opposite and, the labor market tightens up more than expected, right? That's the one you're probably in a higher rate environment than you would otherwise be.
Absolutely. Well, let's go to the the creme de la creme. People want to talk home prices. Are we going to finally get that housing crash that so many people called for?
So this roundup, I spend a lot of time on this one because I try to get, a lot of these forecasts are not published publicly. I have to reach out to these groups. Then I have to reach out to them to see which model or which index they're forecasting for, make sure it's the full calendar year. There's back and forth. And then I try to get some quotes from these different groups. This year, I got 26 different forecasts.
Wow.
The average forecast in Resi Club's roundup is 2.7 in 2025.
Okay.
Last year, the average forecast in my roundup was plus 2.2% for U.S. home prices. And if you look at home prices, I expect that once the year is over, most US home price indices will be anywhere from +2 to +4.5.
Yeah, I think so.
We did just get Case-Shiller and FHFA. I haven't updated this year, but you can see they're all kind of in this 2.3 to 4.4 range.
Yep.
Given that the last month, I do expect a little weaker for the December reading. It's just the end of the seasonal. It's the end of this weakest part of the seasonal calendar, right?
Correct. Yep.
For the reporting. So I think national home prices will be up +2 to 4.5. So the average from last year was at the lower end of the range, and home prices were maybe up a little bit more than the average of those forecasts.
Yeah, not a bad call though. I like the fact that you collected them and you got kind of an aggregate number. That's pretty cool.
And this year the aggregate is +2.7. So
slightly better than last year.
Slightly better, yes. And before I get into these, just an important thing to remember: this is a roundup for nationally aggregated home prices. Right. On a regional basis, home prices can vary greatly, even within pockets of markets, down to a zip code level. This year, the Zillow Home Value Index is up +2.3. While Syracuse is up 9.4, and Punta Gorda is down 7.8%.
Love that.
And one more thing before I go any further is sometimes people will, because I use a lot of Zillow Home Value Index data, they'll be like, "Hey, Lance, I don't trust estimates. Why are you using the Zillow data?" One thing to keep in mind is the Zillow data is very close to what you would see from these other indexes. And so while Zillow might struggle to value an individual property with so much nuance, if you aggregate the data for regional level, they've done pretty good.
Pretty good, yeah.
And so the Zillow Home Value Index is pretty close to the others. I do think it's a little lower than the others. And the reason that I think that is right now is that the Zillow Home Value Index also includes condos. And like Case-Shiller is just single family. FHFA, I believe, is just single family. And so I think that's why there's more softness there, because you do have, like the Florida weakness for condo market and that stuff. I think that has kind of pulled it down a bit. But I just wanted to point that out, that while Zestimates, I think everybody should have a healthy dose of skepticism for them. I do think their aggregated level of their home prices is good. And I like it because they're also slightly ahead, and they publish faster than some of the other indices like Case-Shiller, which is very lagged.
Yeah.
So here's the forecast. This is all 26 that I have. Apollo Global Management is the biggest outlier on the high end. They are the most bullish. If they were right, it would mean that national home prices or some regional markets would have to be up 15, 16, 17, 18, 20%. So getting to 10.8 based off the current trajectory of prices, which have decelerated, they're still growing, just at a slower rate. It would mean that the trajectory of the housing market would dramatically shift in 2025. So I think there's reason to be skeptical on that based on where we are today, where the rate environment is today, and unless something more too dramatic.
I know you've been putting this together for a long time, and I think they may have been one of the first forecasts you got. Did they explain their model, how they got to 10.8? Because it does seem like such an outlier.
No, they didn't. Resi Club data editor Megan Malice, she reached out to them. They haven't gotten back to us. They also didn't tell us what indice or they're forecasting for. They just said U.S. home prices. They did say that, in all of these, I keep a paragraph on what they published. Higher mortgage rates are weighing down on demand, but the inventory of homes for sale remains very low, and housing demand is supported by solid wage growth, high stock prices, and high cash flows to owners of fixed income, including private debt. So not exactly sure how they got there. AEI Housing Center is 5.5%, Wells Fargo 4.9%. Goldman Sachs 4.4, Redfin 4. I'm not going to go through all of these, but the average is down here at 2.7.
Mhm.
And a part of that gets pulled down because of Morgan Stanley's -2, which I'll go show their paragraph on their thoughts as well. Macro Edge,
Yep.
Moody's, Erdman Housing Tracker, PNC Bank, Freddie Mac, Reventure, Nick over there, Mortgage
Yeah,
Bank.
look at that. You actually have Reventure. Reventure Consulting is here we go, folks. Reventure Consulting can no longer be called a crash bro. He is talking about, roughly speaking, up 1% for the national home prices. That does not sound like a crash to me.
Yeah, and so Nick's take is that national home prices up about 1% next year for the Zillow Home Value Index.
Mm-hmm.
He thinks that the Midwest and Northeast will see the strongest growth, but a little weaker than they saw in 2024. And then he expects some declines in places like in the Sun Belt, like Texas and Florida.
You know what? I think that's very reasonable of Nick to say. I agree. Actually, I agree with all of that.
Yeah, well, that's pretty close to my current view as well. Is kind of in that ballpark of, it's some of these golf markets where there's probably going to still be weakness.
For sure.
And the Midwest and Northeast, just based on how tight the active listings are still in those markets, down 60, 50% from pre-pandemic.
From pre-pandemic, they're still down. It's crazy.
Yeah, they're still down. So I expect it's still going to be competitive. Sellers are still going to have the power there come the spring season.
I like
So let's get to Morgan Stanley. They are the most bearish, and they were the most bearish last year. They had a negative forecast for 2024. It was not right, and their model has kind of pushed that out. And so one thing that I really like about Morgan Stanley, and some people might not like this, but they always give a bear case and a bull case as well. So last year, their bull case was that home prices would be up like 4 or 5%, which, it's kind of close to where we are now, right? Or 3 or something like that.
Yeah.
And it was pretty much that supply would stay tighter than expected. And while demand would be suppressed and affordability would be, the balance of power would still be in the court of the sellers because there's just not that much active inventory. And that the economy would probably be more resilient. This year, they expect national home prices to fall 2% in 2025 and then also rebound 3% in 26. So pretty much they're saying flat to 27 is what that means. But for 25, their bull case is plus 5% and their bear case is minus 5%. So they have a -2 for their call for base, but they think bull case could be plus 5 and bear case could be -5. And to some people, for like a stock market, they might think, oh, -5, +5, that's actually not that big of a difference, right? But in the housing market, that is actually a really wide gap.
Yeah, it's really wide. Yeah.
That's the difference between, let's say, a 2019 being the +5 and a 2000. What was 2009, 2007?
Probably.
Those were 5. And so their bull case is even if for sale inventory increases, the overall supply environment should remain very restrictive relative to history. If demand is even more robust than we are expecting, as mortgage rates continue to decrease, we could see sales volumes exceed our expectations while home price appreciation accelerates. So that's their bull case.
I like
their bear case is, on the other hand, if inventories were to increase more than we are anticipating and demand remains challenged because of affordability is still under pressure, we could see both sales and home prices come up short of our base case. We do not believe that defaults and foreclosures and thus distressed transactions will increase significantly in this cycle, and especially not in 2025.
Yeah.
The increase in supply into a weaker demand environment will likely weigh on prices. And so what they're saying there is, if inventory increases and demand is weaker than they're expecting, like it also comes back, that's when they think you could have some give up in prices. And where they're saying that prices would go to 5% plus is if, maybe actives come up a bit, but demand bounces back up faster than expected. So I think what they're really saying is that while +5 and -5 might be very different environments, usually, because we're in such a constrained environment, if housing demand were to swing one way or the other quickly, it could bounce the prices, is what they're saying. I don't necessarily disagree with that much. It's really just that I think unless something changes dramatically in the economy, and that's the part they're not really bringing up here, I don't really know if housing demand comes back down more than it has. It seems to have troughed. Maybe it's, rates go high, 8, and we're there. Like you would need demand to, even this year, I don't really think the demand came down more. It's just that we kind of stayed in this suppressed demand environment, and plus some of the new listings and the home builder still moving it, it was enough to get the actives up some.
Love it. Well, this has been a great collection on mortgage rates, active inventory, and home prices. If people want to be in the know, where do they go?
Yeah, Google ResiClubAnalytics.com, or go into Google and type in Resi Club. You'll find my site. Put in your email. You'll get signed into my free list. If you want to get more data, more analytics, more research, I also have a premium offering called Resi Club Pro. Real quick before we jump, this is that same chart as you saw earlier, but I transposed it so it's a little easier to see them all.
Yes.
23 are up of the 26, 3 are down. And here is also all the forecast overlaid on the Case-Shiller index. Not all of these forecasts predicted for Case-Shiller, but just because it was the most commonly referenced index, I went ahead and put them on here. You will see that most of them think slightly up for 2025.
AKA no housing crash in 2025. If you are in that camp, we're going to start talking 2026 or 2027. ResiClubAnalytics.com. Go there and get your free newsletter. Thanks, buddy.
Thanks for having me, Super.